of a tilt from policymakers, that the bigger worry is actually a policy mistake because you don't act quickly enough rather than leave accommodation too late.
This idea here of the balance of risks and where it lies, right? Is the balance of risks moving more towards overshooting with inflation, or is it more towards perhaps not being easy for long enough? And this all comes at a time when the stock market cannot go high enough for anybody, Tom. I mean, this to me, I think, is actually one of the key aspects. How does the Fed respond to a buoyant and ever more buoyant stock market?
I'm going to stop the show and say it's real simple. They're slaves to the data. They're as ex post as I've ever seen in my life. They've got some newfangled theories, which are going to be in those papers at the Fed. And again, Lisa, you've trumpeted the inequality debate. That's a new mission for the Fed. Great. But the answer is they're going to do one and only one thing. Wait for the data.
But honestly, to Francine's point here, the data is bifurcated. You are seeing inflationary pressures in places. You are seeing data that might support their going. And the idea is, if they wait too long, do they have the tools to counter inflation? Do they have the tools to potentially tamp down on trends that are independent, frankly, of their purview?
Seriously, it'll be interesting to see tomorrow if Chairman Powell brings in one of the inflation summaries here, like the Dallas trimmed or the Atlanta inflation data, and particularly my favorite of the Cleveland Fed as well. Speaking of data, let's do data. Futures red and green on the screen. The VIX, again, giving me much. It's boring, 17.31. Yield, and we round up to a 1.36% on the 10-year yield. I'm sorry, I think this is a trend that bears looking at into Thursday, into Friday, indeed into next week as well, as we've seen yields come back very nicely. I'm going to leave it there right now because what you want to hear about is the equity market. This at Dow, 35,405. Sam Stovall, a few years ago, was sitting on an acclaimed father's lap, considering the Dow at 350 or whatever it was back then, with CFRA and their chief investment strategist. Sam, we get heated mail when we talk to bulls. What's the level of your bullish belief right now?
Well, good morning, Tom, and thank you for that intro. Yeah, I never crushed my father's lap, but good thing I haven't sat on it in a while. Anyway, the feeling is that the path of least resistance continues to be higher. Even though we have seen a creeping up of the 10-year yield, we're still seeing investors gravitating toward the growth side of the equation, also looking toward real estate, et cetera. So 46.20 is our target.
Lisa, please go ahead. I'm sorry, my fault.
No. I mean, Sam, no worries. It's just, I got to jump in because you talk about 4,600. You sound like a bear. I mean, honestly, this is a market where people can't get bullish enough. And are you also thinking 5,000, 6,000, 7,000 and projecting out incredible earnings and returns for the foreseeable future?
Well, what's the old saying? You target a price but not a date, or you forecast a date but not a price. So yes, those numbers that you mentioned will be attained at some time down the road. But I think we also have to make sure that we are risk mitigators at the same time. We've gone 3 times as long as we normally have between declines of 5% or more. I think that the market is vulnerable to some sort of an upset, whether it comes from a policy misstep, whether it comes from geopolitical factors, et cetera. So I think that we really have to just not assume that the sky is the limit.
Sam, how do currencies actually play into some of your equity calls?
Good morning, Francine. Well, currency is an important part. When we look at the technicals of the euro versus the U.S. dollar, the weakening that has been experienced over the intermediate term implies that investors do expect interest rates here in the U.S. to be picking up, possibly because of the Fed initiating their tapering in the fourth quarter of this year, possibly because of the continued improvement in economic activity and maybe even the peaking of the Delta variant.
Sam Stovall, you are acclaimed for understanding the vogue of the moment, the fad. Remember tick. Everybody, the world stopped like 14 times a day to look at the tick data. And there was the put-call ratio and on. What's the fad right now where you say, get your radar up and be cautious?
Wow, no pressure there, huh, Tom?
No, none.
Well, I think that the fad really is growth versus value. What kind of a rotation are we possibly going to be seeing? Right now, investors are chock full of growth stocks once again, whether it's tech, consumer discretionary, communication services. Yep. And the real question is when or if, and I think it's more a when, not an if, that we see a rotation back into the value side of the equation because the economy is expected to be improving. We are likely to be seeing passage of one or both infrastructure packages, and we will start to see the 10-year yield creep up once again.
Meanwhile, Jim Bianco was on Bloomberg Television yesterday, and he was talking about the Fed put that's sort of implied in markets, that there is this belief in stock investments, that if there is a big drawdown, and a big drawdown could be 5 to 10%, the Fed will step in. They will decelerate their tapering. They will become even more accommodative. Do you agree that there is sort of this implicit backstop baked into valuations where they are in equities right now?
I think that could be a mistake to assume that the Fed will be stepping in should we see a 5 or even a 10% decline, because those are fairly natural in the stock market. And I think that if, however, we do start to see the stock market fall into a bear market territory and that there is an actual risk to our financial system, then by all means, the Fed will step in. But I don't really think that the Fed is going to be stepping in, if we trip, fall, and just scrape our knee.
Sam Stovall, we spoke the other day of the 10th anniversary of Steve Jobs resigning from Apple. Everybody, including me, got that wrong. Woe is me. Steve Jobs, he died tragically on October 5th, 10 years ago. And this guy, Tim Cook, he can't do it. And as you have chronicled, Apple to the moon. How do you know when to get off these stocks that just go and go and go and go?
Well, you look at the fundamentals, you look at the technicals, and you listen to your analysts. What's the old saying? The analysts do the work, but the investment strategists take the credit. I love that. I hear what Angelo Zeno says about Apple, and wait for his commentary from a fundamental perspective.
What's he say? What's he say right now?
Right now, still a favorable outlook for Apple. We have it ranked 4 stars, so we like it, but we're not willing to bet our bonus on it.
Folks, so much of this is not making money, it's not losing money. And when I lecture on this, and Stovall doesn't get a royalty, I say nothing helps you not lose money like the star system of CFRA. It is a great and beautiful thing. Mr. Stovall, go away. Thank you. That was a clinic. Thank you so much. Sam Stovall, I can't say enough about his work over the years. Lisa, the star system, everybody's like, it's boring, it's stodgy, it's like watching paint dry. Man, when they fall out of love with something on the star system, get your radar up.
Yeah, this idea that people take notice and that there is this respect for that. I just wonder how the star system accounts for valuation and how the input of the 10-year goes into that. I mean, honestly, I'm going back to Dave Wilson's chart earlier in the week where he was looking at the correlation, the inverse correlation between bond yields and tech stocks. And I wonder how much that can continue. I mean, in other words, if you have these revenues and you have this secular story, how much do these have to be linked, or are they potentially going to try to go their own ways as the world becomes a rosier place, Tom?
Well, it's going to be interesting to see. Right now, red and green on the screen. Francine, quickly here. The equity markets, many people in Europe are saying go long Europe. That Europe's behind. You got to own Europe.
Yeah, a lot of people, and that is also a currency call. So if you were listening to Sam and some of the others, I spoke to Janet Henry earlier this morning, it's also euro-dollar call. Tom, I think what people are maybe underestimating is that when you look at some of the budget for a lot of the countries, it could all be disrupted because of elections. So if you look at the uncertainty of the elections, be it Germany, be it France in 8 months from now, you don't know what comes next. And so that could actually change the trajectory for some of these European equities, unless it's European equities skewed towards the U.S. market.
I do know what comes next for us. Ira Jersey with us. No, not on Premier Football this weekend. Ira Jersey on what we're seeing in liquidity and on the wall of money that's out there, particularly overnight repo. Really looking forward to catching up with Ira Jersey. John Riding, after Michael McKeon claims. Really, really strong 40 minutes to come. Stay with us. This is Bloomberg.
With the first one news, I'm Rishka Gupta. The US and UK are warning their citizens still in Afghanistan not to travel to the Kabul airport. They say there are threats of a terror attack. The Biden administration says it knows of about 1,500 Americans who are still in the country. President Biden and Israel's Prime Minister Naftali Bennett plan to discuss strategy on Iran today at the White House. Both countries consider that Iran is speeding up its nuclear program at an alarming rate. The U.S. favors a diplomatic agreement to halt the nuclear activities. Israel has said it may use secret attacks. Vice President Kamala Harris says she raised human rights concerns with Vietnamese officials after being criticized by activist groups in Hanoi. Harris said she brought up the issue of dissidents serving prison terms, but when she was questioned, Harris didn't explain how Vietnam's human rights record is different from that of China, another communist country that doesn't tolerate dissent. In India, regulators have cleared the way for the Boeing 737 MAX to resume flying. The plane was grounded worldwide more than 2 years ago after 2 fatal crashes. 17 regulators have now okayed the 737 MAX, and a Boeing team went to China this month to demonstrate the changes it's made. Bloomberg's learned that Western Digital is in talks to merge with Japan's Kyosha. A deal involving the 2 chip companies could be worth more than $20 billion. The companies are longtime joint venture partners. A combination would create a bigger competitor for Samsung in the market for memory chips. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishka Gupta. This is Bloomberg.
The session started and wrap up the trading week.
News.
Who knew that one earnings story could tank the entire market?
There's upward pressure on wages.
Analysis.
This is really a slow, ongoing implosion.
Context.
Is there veracity to this granular data of ADP?
It's an ugly report.
The power of the Bloomberg terminal. The power of Bloomberg television and radio.
Tesla's the one that we got our eyes on.
Bloomberg has it covered. Jackson Hole Economic Symposium is going virtual. Bloomberg will bring you the latest with key discussions between central bankers and financial leaders, plus an extended edition of Bloomberg Surveillance Friday from 6 to 10. Coverage begins Thursday on Bloomberg Television and Radio.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
It's unlikely. I know there's been a lot of information that has come out to really change the forecasts since they had their last meeting. I don't think Jay Powell wants to upset the apple cart. I really don't think he's going to try to push people in one direction or another. Obviously, there are a lot of different views around that Fed table, and I don't think he's going to try to say, okay, here's my view, and everybody better follow it.
The mathematician from the Booth School, Randall Krosner, first-rate financial economics, if you will, always good with the Booth School in London. We're thrilled to get his comments here on the event forward. We're going to digress right now and talk liquidity. Ira Jersey is definitive on this. He drives forward Bloomberg Intelligence rate strategy, and he's looking at the 30-year bond, the Austrian 90-year bond. Ira, I just want to know about the trust money, the overnight money, and I'm sorry, it's inching up 1 trillion, 1.1 trillion. How and when does the overnight repo market stop its ascent?
Yeah, so I think the Fed's facility, which is what you're talking about here, Tom, is going to continue to grow because the economy doesn't need cash at the moment. And all that the Fed's doing by buying all these assets is creating more cash, which then people say, well, what are we going to do with this? We don't want to make zero because, our alternative in the repo is the repo market, and that's not making any money. So they put the money to the Fed for a whopping 5 basis points, but it's above zero, right? So people are putting their money there. Our estimate is it's going to get somewhere between 1.7, 1.8 trillion before it's all said and done. And that's assuming that the Federal Reserve starts to reduce its asset purchases, so that dreaded taper in November.
Okay, a smart guy like you who says calm down, says 1.7 trillion, others say 2 million, whatever. Do you have any experience at how we come down from 1.7 trillion?
Yeah, well, we do have a little experience because at the end of when we tapered last time, the Federal Reserve had the reverse repo facility or had something largely similar, and what happens is over time the economy continues to grow, more cash is demanded, and less people use the repo facility, and that is something that I suspect will happen again. Now, of course, now it's significantly larger. The Fed purchases have been significantly larger. The market is just bigger. One of the oddities that's occurred over the last decade and a half or so is, look, when you go back and you look at 2005, 2006, kind of, when I first started in rates and moved from credit, the repo market, the non-Fed repo market, is about the same size now as it was then. Meanwhile, the Treasury market, which the repo market, the repurchase agreement market helps fund, is 5-6 times larger. So so there is a funding kind of gap out there.
Lisa, I just want to admit
that has to come in and help.
Lisa, quickly here, do you understand, Lisa, that in the fixed income racket, to move from rates to credit is like going to the dark side?
Yeah, but to move from credit to rates is traditionally thought of as the downgrade, and yet in this world, rates really determine
Jersey
all
never
of credit.
recovered.
No, I mean, but in all honesty, but it's the opposite at this point. Wither rates is wither credit. It's the same story in many cases.
Well said.
Apart from some of the security selection. Ira, when you talk about the repo market, though, we're talking about the functioning of the world's biggest and deepest market that is actually starting to function a little less well. And you're starting seeing liquidity dry up in certain corners of the Treasury market at a time when people say there is potential for some sort of disruption. What's your view on the fragilities that we're seeing right now under the surface?
Yeah, the issue with the Treasury market right now is that there's this what I call an illusion of liquidity. So there's liquidity, and then all of a sudden, sometimes there's not. And you saw that last March. That's one of the reasons why the Fed stepped in and did those massive $1 trillion worth of Treasury purchases. And you saw it at other points over the last decade or so too. And a big reason for that is, quite frankly, some of the bank regulations. So the Basel III regulations. Some people talk about Dodd-Frank and like the Volcker Rule. It's not as much that as it is the fact that banks cannot and dealers that are owned by banks in large portion can't expand their balance sheet and shrink their balance sheet at will. They have to keep within certain lanes, and because of that, when there is a significant amount of selling or a significant amount of buying, you can see these wild swings and liquidity just dries up. And I think that that's going to be something that once or twice a year is going to rear its ugly head, and you'll get outsized moves, and then people will do studies and everything else. But at the end of the day, it's just that there's no circuit breaker to allow to allow demand to be absorbed when there's a significant amount of selling or a significant amount of buying.
But Ira, why do we not have those circuit breakers? And is anyone looking at putting them in place?
Well, so the regulators talk about this as saying they want institutions to be safe and sound. And in order to do that, you have to hold a significant amount of capital. Keep in mind, before Basel II was implemented, Basel II and a half actually, the treasuries had zero risk weight by under the Basel regulation. So basically banks and dealers could hold as many of them as they wanted in whatever risk they wanted. So 30 years and everything. And a lot of interest rate exposure could be basically taken on the balance sheet. They can't do that anymore because the Basel regulations say, hey, you have to hold a certain amount of capital even against the safest assets that are out there. So that's one of the reasons why like the repo market hasn't grown, because repo, when you do repo now, you have to hold equity capital against that, even though it's secured, the underlying is secured by a treasury security.
Ira, it's August. I mean, I'm worried about, like Ted Lasso having a Christmas show in August. What was that about? Does it matter, Ira, that Ray Knight is coming back to coach Richmond? When you bring an old player like that back to coach, does that really work in soccer?
So, player coaches and, can work out very well. And in fact, when you look at some of the highest level coaches, some of them were players, and some of them were not even necessarily some of the best players. You look at a guy at Liverpool like Jurgen Klopp, who you could say is one of the best managers in the world. And, he never played. He never won a Champions League right now. And then you go across the other side and you look at someone like Pep Guardiola at Manchester City. And of course, he won everything that there was. So I think that it's important for someone to know the game and be a student of the game.
Oh, this is
and a lot
great.
of times those are players.
Francine, I miss John so much. Ira,
oh my God. I literally just was writing that. You clearly miss him a lot.
Did you see, Francine, how Ira Jersey totally changed there, talking about Richmond and, what Ray Knight's going to be doing and all that?
I still can't believe you know the rules of the. I mean, 18 months ago, Tom, you didn't even know what football was.
Yeah, I don't. I hope I'm spelling that right. Ray Knight of Richmond.
I thought you were saying soccer. SOCCER.
Ira Jersey, thank you so much on explaining 1.1 plus trillion of overnight repos. Lisa, we're 5 minutes away from claims. We're joking around, but this is important.
It is important, and I think it's important for what it tells where the weakness is not. To see progression, to see another post-pandemic low in the number of claims, albeit on an elevated level, highlights that the problem is not with people leaving work or getting fired. It's there aren't enough people to hire. And that, to me, is a question the Fed is trying to get their hands around.
It is a unique character, and we'll have to see how that unfolds. Michael McKee will join us, and then we're thrilled to bring you John Riding of Breen Capital, their chief economic advisor. Red and green on the screen, that yield 1.36%. Stay with us. This is Bloomberg.
Hello traders, I am looking to trade euro, and I'm placing an order to sell euro at 117.71. So if you look into trade euro against United States dollar, please place an order to sell at 117.71. Okay? And I'll speak to you later, guys.
直接会場に行って観戦するということも難しいお子さんがいるんです。このように冷房の効いた香港の体育館の中で、それこそ大会の最前列で観戦ができる、体験ができる、こういうことをとてもありがたいことだなというふうに思っていますし、この技術に感動しています。予想以上に子どもたちの反応が良かったというのはですね、とても校長として嬉しく感じております。この子どもたち、どれだけオリンピックの心待ちにしていたのかっていったことがよくわかるような今日の表情です。
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Happening on the ground right now, just in terms of consumer price tolerance?
We see a strong consumer right now, and you can see that even in the early start to back to school and back to college season that we're really pleased with. And I think if we step back and look at the quarter, you know, we see the evidence of that strong consumer.
Okay, guys, position opened at 117.71. So all of you guys who managed to enter position, well done. Stay with me. If you, for newbies who want to find out how we trade, you need to get a strategy at companyeye.co.uk. Otherwise, you copied this trade, you still have chance because the price moved up. You can enter position, and I'll speak to you later. Stay safe.
Economic data. Francine Lacroix, in for John Farrow, Lisa Bramos, and myself, and waiting here to get out not only the GDP second look, but also the Thursday claims data as well. We're waiting and waiting and waiting. And well, we're waiting, Michael McKee, we're waiting.
We've got
there
the
we
numbers.
go.
We've got the numbers, Tom. We've got the numbers that you want to see. The jobless claims numbers for last week, August 26, 353,000. That is, what are they saying here? An increase of 4,000 from the revised level, because we have to look at the revised level from 348,000 to 349,000. So that's just noise, basically. The movement. I wouldn't read anything into it about difficulties in terms of the labor market on the basis of how many people in total are getting claims. This is interesting. It's 2 weeks delayed, so it's August 7th, but this would incorporate all those states that stopped paying extended unemployment benefits, and it still rises by 182,000.
Is the Delta variant
a little
in here?
over 12 million. It's almost impossible to say at this point.
You don't know.
I suppose it could be, but at this point, you're probably looking at companies that didn't come back rather than companies that are letting people go because of all the anecdotal stories about how hard it is to find people.
I'm looking at stasis in the bond market at 135 yields in fractionally. I don't want to oversell that. The revisions, Michael McKee are there. The thing I see on the Bloomberg terminal, Mike McKee, is GDP second look, 6.6%. Are there any papers at Jackson Hole that are actually going to address how America comes out of a boom economy different than the last boom economy of 1947?
It doesn't look like that's specifically a topic, how they come out of it, but there is going to be talk about how monetary policy deals with the new environment that we find ourselves in. First, you have to establish what your new environment is. You do mention 6.6%, which is 0.1% better than the initial report for GDP, 0.1% worse than the forecast. Personal consumption, 0.1 percentage point better, 11.9% compared to 11.8%.
Yeah.
So not a major adjustment here. And I haven't got the details yet, but what I was wondering about, Lisa, was the inventories.
Yeah.
I'll have to look for that in a second here, but that's going to be the swing factor going forward.
Mike, it's interesting to me to see the markets not very much moving at all on this data, even though there is some surprise here, especially to the downside, pretty consistently across the board. And it's not just the wrong kind of upside surprise to jobless claims coming in stronger than higher than expected, which is bad. But it's also personal consumption coming in softer than expected. And I do wonder to what degree markets shrug off any data as simply backward looking at this point.
I think you have to with GDP for the second quarter because that ended in June. And now we went into July with some momentum, and certainly 11.9% is not bad. But now we don't know because of the Delta variant impact on people's spending habits. We saw in the retail sales report for July a surprising drop in the number of people who were buying or the amount they bought online, which is what you would expect them to do if the variant was keeping them home. But we'll have to see when we get to the spending numbers tomorrow what services were like for July.
We will see. Michael McKee, thank you so much. And on to Jackson Hole. Those papers released, I believe, tonight, 7 p.m.-ish, is when we'll see the agenda for the virtual Jackson Hole. The yield, 1.3508%, doesn't give me much. Norway with news this morning. This is the Norges Bank, not the Sovereign Wealth Fund, the central bank, Øystein Olsen, to step down February of next year. I'm going to assume as a measured and esteemed economist, that is something along the pace of expectation. Right now, because of time, we got to get to John Riding with us with Green Capital. John Riding, thank you so much for joining us today. John, do we understand or do we have any inkling of how we get from boom economy to 6.6% with a glide path down to whatever potential GDP is? This is original, isn't it?
Well, it's going to be very difficult with monetary policy still in full easing mode, and that's obviously going to be the key thing that people are looking for from this conference is what hints Chairman Powell gives in terms of the timing of a tapering announcement. But I just want to point out one thing that you didn't pick up in your discussion of the GDP report, and that is we get the profit side of the economy for the first time. And corporate profits were up a non-annualized 9.2% in the quarter. And that's very important for driving the economy. You know, economists like to think about looking at the demand side and consumer spending, but we also have to remember there's the incentive to supply, the incentive to invest, the incentive to hire. And those profits data, as we suspected they would be, were very strong in this report.
John, overall, is there, do you believe that actually the Fed wants to move so that they don't miss the boat?
I think the Fed's divided, and I think Chairman Powell has to decide which side of that division he wants to come down on. I think that we have a significant number of presidents and at least one governor who thinks that 2022 is probably the time to lift off on rates. And to lift off on rates, pretty much everyone's in agreement, you have to stop buying treasuries first. Otherwise, it just gets messy because you're easing on the one hand, raising rates on the other. So I think it's divided. But I do think that coming back to Tom's perspective, How do you transition from a boom economy to a more stable economy? You don't do it with monetary policy still in full easing mode.
John, just to bring to you some headlines from one of those Fed officials who do have that view that perhaps 2022 is time for liftoff. The Fed's Jim Bullard, speaking in an interview on the Death Star, as Tom would say, on CNBC, is saying that there's more inflation than expected. He expects at least 2.5% inflation in 2022 and says that the Fed should get on with tapering already. And this sort of echoes some of the comments from Esther George that she doesn't see the Delta variant as potentially delaying anything going forward. Right now, based on what we're seeing, do you agree? Do you think that there is more of a liability for the economy if they hold out for longer and don't start tapering by September, by October of this year?
I think there is. And for one reason, the Fed will raise rates when it has to raise rates. So the later you wait to start tapering, the faster you have to reduce the pace of your purchases and the more disruptive that might be for markets. So that's the first thing. We're at a very low level of yields. Prepare the markets for the taper and ask yourself, why are we still easing if we're the Federal Reserve? Especially when inflation, 2.5%, Jim is 2.5% to 3% for next year's inflation rate. We're at 3%, but we all see the risks to the upside. It's a bet that this inflation spike is going to be transitory. A lot of the surveys continue to come out with very, very high price readings of the kind that we haven't seen since the early 1980s. So if you're managing risks, the greater risk to me would appear to be losing the gains that you've made, very hard-won gains against inflation, than the risk that the Delta variant is going to cripple the economy. We have a very effective policy tool to deal with the Delta variant. It's called vaccination. And we're going to get booster shots. And states in which people are not as highly vaccinated have much higher breakout rates. And that's real personal human tragedy, unnecessary deaths. But monetary policy doesn't really speak to that. And the claims data don't suggest that the Delta variant case surge is having a material impact on the economy. Now, the third quarter may well be a much slower quarter than the 6.6% in this number, but I don't think that the consumer with $2.5 trillion of excess savings is going to be a major factor in the recovery in putting the brakes on here.
John Riding, thank you so much. Greatly appreciated with Green Capital. Too short a visit.
Let's place stop, and I'm going to place stop for euro at 117.661. Okay, stop. We're placing stop. If something happened, we will not close trade in loss. Just here, 117.661. Sorry, 660 right now goes. Yep. Okay, we'll have 5 pips in profit. So all of you guys who follow this trade, please place stop on profit. Everybody who copied this trade, you're already in profit. So well done. Well done. Let's see where it will lead us. If it will move even lower, we will increase our profit. Okay, guys. But whatever happened, you already have profit 5 pips. For new guys, you can get strategy if you want to find out, if you want to trade other pairs, get the strategy on companyeye.co.uk. Stay safe.
And we sat in the little rotunda of primary New Hampshire, I believe in Manchester, the Radisson Hotel, I'll guess. And, you know, CNN was over there, MSNBC over there, Bloomberg was doing its thing, I was doing interviews and all. And everybody was on their cell phones, which was a new thing at the time, and everybody was looking at the same thing. And it was a strange thing called Politico.
Yes.
And I'm like, what's Politico?
Okay, he's talking about the headline that Axel spread.
I'm going to move further. Our stop on profit to 117.61. It will give us 10 pips in profit. And in our case, it will give us £1,000 in profit. So please move your stop on profit to 117.61. Okay, guys, stay safe.
Is linkage into how we all, including all of Bloomberg, look at the cell phone.
Well,
absolutely stunning.
Yeah, the idea of the media and the role ahead. We're not going to be discussing that as much as markets ahead coming up today on the Open. John Hancock, investment management company, co-chief investment strategist Emily Rowland joining us to discuss it all. This is Bloomberg.
With the First One News, I'm Rishika Gupta. Rising coronavirus cases are limiting what Fed Chair Jerome Powell can say about what's next for U.S. monetary policy. Powell speaks tomorrow at the annual Jackson Hole Central Bank Symposium. The conference has been turned into a virtual one this year. Powell is expected to reinforce the message that it will probably be appropriate to begin scaling back the Fed's bond buying program by the end of the year. Bosses in Manhattan have lowered their expectations for a return to office next month. Cases of the Delta variant are on the rise in New York, and a survey by Partnership for New York City says employers now see 41% of office workers returning by September the 30th. That's down from an estimate of 62% in May. Australians are eager to travel overseas again after 18 months of being cut off from the rest of the world. Qantas says demand is so great, it's bringing its giant Airbus A380s out of mothballs early to handle the load. Airline's CEO gives the credit to Australia's vaccination program.
What you're seeing happening at the moment in Australia is the biggest uptake of vaccinations, higher than the peaks in the US or in the UK when they were rolling around at the start. There was overwhelming demand for it, and we see that continuing. So we're comfortable that we should be able to get to those 70-80% targets.
Flights from Australia to the US, Singapore, Japan, and UK and Canada will start in December. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishika Gupta. This is Bloomberg.
Are you still committed to the U.S. pickup market? You mentioned how small it is, and I know you do good business at Frontier, but a lot of times Americans want something bigger like the Titan. Is that, do you plan to stay in that market as competitive as it is?
I mean, for us, market is one thing. The second is what customer aspires for from Nissan. And customer in United States aspire for sedans, SUVs, and the pickups. And Titan is a great pickup truck, and we are, of course, focusing on the Titan. But as I said before, that in our whole lineup, our main focus is always been in the sedans and SUVs and the smaller pickup truck.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit.
Okay, guys. Position closed on euro, as you can see, at 117.61. We just, as you remember, about 10 minutes ago, we sold short at 117.71. And right now, position closed at 117.61. We have 1,000 pounds in profit. 1 pip equal 100 pounds. In your case, it all depends how much you decided to invest when you decided to trade this pair. Okay, guys? I'll speak to you later. Stay safe. Let's move on. Let's not concentrate on one winning. Okay?
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
Like so many of the passenger airlines, our ridership contracted significantly back in March and April of 2020. Now we're at about 65 to 70% of ridership recovery, with stronger bookings into the fall season and beyond. So good ridership recovery, which I think underscores the essential nature of the services that we provide.
Mr. Flynn, William Flynn of Amtrak, the Chief Executive Officer there on where they stand on infrastructure as well. And what he knows is if he needs people from Tribeca to, well, you know, go on up to Penn Station and climb on board Amtrak, particularly at the new and wonderful Moynihan development, they got to live somewhere. And we saw that yesterday with Steve Ross and Related coming out with a huge announcement of optimism on New York City with Blackstone. It's $250 million to redo, Francine, you're going to love this, Truffles Tribeca. What kind of a name is that for a building? But that's what it's, honest to God, Truffles Tribeca is what they call it. He used to plant truffles in Australia. Scott Crow joins us right now with Center Square Investments, their chief investment strategist here. Scott, come on. Blackstone, $250 million over to Related. That is optimism on New York City real estate.
Well, absolutely. From a living standpoint, New York City is already roaring back. Rents are back at or above pre-COVID levels because people want to live in cities. They like the excitement of the cities. They like the amenities that cities bring. But the bigger question is, will people be working in cities as much as they used to? And that's why the office market continues to be in a little bit of a funk, but the residential side has just come roaring back.
You have been, from your days at Cohen Steers years ago and the rest, you have been research-based. What is your research on if, how, and in what way we will return to our offices?
Okay, so office is the new retail. And that doesn't mean that office is the new amenities. It just means that office is the next major sector that's going to be disrupted by technology. We can shop from anywhere, and now a little bit we can work from anywhere because we're letting technology help drive how we work and drive that bus. So what it means in a nutshell is that we are going to go back to the office, but in a different way, and we're going to use office less than we did before, but in a very different way. A lot more about collaboration when you're there. It's going to become almost more of a hospitality-based model with a lot more flexibility built in. Employers are going to have office space that is very attractive to employees from a aesthetics, from an amenity standpoint. So the whole game's going to change. Just think of an Apple store, right? It's beautiful real estate.
Right.
Apple only is in 200 locations, not in 1,000 malls across the United States.
Okay, Scott, I'm looking at prices in Manhattan, right? In Soho, it's $1,843 per square foot. I don't know if that rises or not, but why would I live actually in the city center and not live outside and then rent somewhere a couple of days a week because I'm working there?
It's a great question. people like being around people. People like being in Soho. People like being in Manhattan. There are more people that want to be in Manhattan than there are condominiums, right? There are probably not more companies that want to be in Manhattan than there are office buildings. And that's the big difference. And that's why if you look at dollar per square foot pricing, it's $1,800 for apartments and it's $800 for office. And that's the reason for that.
Right. All right. Are people, changing what kind of real estate they want because of the hybrid working from home model?
There's been a value transfer away from commercial real estate to residential real estate because we're doing more of our activities, quote unquote, at home in our residences. So yeah, absolutely. The kinds of real estate that people are investing more in their residential real estate. They want that extra bedroom, that extra half bedroom, because that is going to be where they're spending a lot of time doing their work.
Scott, tell me about the malls in the suburbs. I mean, everybody's focused on cities and it makes for great financial media press and there's this, that, and the other thing. But you have so much experience of not so much strip malls and not the mega malls, but the in-betweeny malls. They got a Starbucks on one corner. They got a Chipotle on another corner. How are they going to do in the next 10 years?
Yeah, so I think, look, the mall industry is going through a huge consolidation. In fact, one of the things that's been helpful for companies like Simon Property Group is that COVID really accelerated a rationalization of the supply. In other words, lots of malls closed, all right? So we're getting closer and closer to equilibrium as it relates to the number of malls we have in this country versus how we want to shop in the future. But there's a big, exciting part of retail that's doing very well right now that we're a big investor in at Center Square called service properties. And that's because services are taking up a larger and larger share of everyone's wallet. Goods are all going online, but services, so your Starbucks, your Chipotle, your hair salon, your dentist, your doctor, your massage parlor, etc. We're spending more money on these things.
Right.
And that's actually a very bright spot within retail that not many people are seeing right now because everyone's concentrated on the headline, which is, the local mall closing.
Scott Crow, not enough time. Thank you so much. Greatly appreciate with Centerbridge there. It's something we don't, Center Square, I should say, with Center Square. And I must say, we don't spend enough time on this, on commercial real estate and those dynamics. Francine, what is fascinating about the Fed speak is we have Esther George talking to our Michael McKee. Yeah. Time to get taper started is the headline. Bullard's over on the Death Star saying, time to get taper started. I wonder where, up to Powell and after, where are the people out there that are going to say, wait on taper?
Right. And I don't know whether that will have that much of an impact. If you look at the timeline, Tom, and we've been talking a little bit about this over the last couple of days, interesting that Jim Bullard, actually talks about getting taper done early so that it gives a little bit more flexibility to the Fed and gives it a little bit more options on raising rates. Now, there was a beautiful piece by Liz McCormack on our Bloomberg terminal. You can also find it on our website that basically argues we're so focused on tapering. What the market is really worried about is when you start rising rates. And
Agreed.
So that's the lens through which you should be watching it. And it's interesting that actually, Jim Bullard just brought that up, minutes ago.
Right, and we saw that from Ira Jersey as well, this partition that's out there. What I would also suggest, folks, is we've got loads and loads of data to come out as well. As we move on through the morning, there's going to be a lot to talk about, including in Washington, which has been fairly August silent this morning. Really distressing news out of Afghanistan. We'll continue to watch that story, and particularly around the beleaguered airport in Kabul. In economics, well, it's a 6.6 American GDP. That's a second look for the second quarter. The market's taking it in stride, but critically looking at the tea leaves here, 1.3661 on the 10-year yield. I'm sorry, that's a higher yield and really bears scrutiny as well. The VIX 17.48, red and green on the screen. David Weston with Ms. Barr of General Motors. Look for that at 12 noon today. We continue on Bloomberg Radio and on Bloomberg Television. Good morning.
story in cannabis remains very strong, even after the sort of loosening of the pandemic. There was a worry that there might be wallet spend competition, but so far the cannabis sector seems to be holding up very strong.
Chevys, Caddies, gone electric? What's GM's next move? CEO Mary Barra joins David Weston for an exclusive interview Thursday on Balance of Power, live from Detroit. And the conversation continues Friday on Wall Street Week. Coverage begins Thursday at noon on Bloomberg Television and Radio.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar. Drumbeat to Fed Chair Powell from New York City. For our viewers worldwide, I'm Lisa Abramowitz in for Jonathan Farrow. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg The Open with Jonathan Farrow.
Let's begin with the big issue, waiting on Chair Powell.
All eyes are going to be on Fed Chair Powell's comments.
Chair Powell.
Chair Powell.
Fed Chair Powell.
We're certainly going to be listening very closely.
We are not expecting any strong signals.
The July FOMC minutes really kind of stole the thunder.
The general consensus now is that Jackson Hole is going to be a little less exciting. You have to look beyond Jackson Hole.
For the Fed to actually communicate the tapering.
They're not making an announcement at Jackson Hole.
Look more toward the September Fed meeting.
What Powell will make clear on Friday is that
the idea that tapering is not tightening.
Jay Powell is a chair who proceeds very deliberately, very carefully.
Everybody is waiting for Jay Powell's speech on Friday.
The Fed's taper timeline taking center stage ahead of the virtual Fed Jackson Hole Symposium. Kansas City Fed President Esther George weighing in on the debate, speaking with Bloomberg's own Michael McKee.
I think it's important to really center on when we believe the progress in the economy is sufficient to start that process. And that's really where I'm focused. In that sense, I think we should get started this year so that we can begin to pare back the amount of accommodation, watch to see how the economy unfolds after that.
And we also got some similar commentary this morning from Jim Bullard of the St. Louis Fed, basically reaffirming his goal of getting the taper going sooner than expected. Michael McKee, terrific interview with Esther George. Thank you so much for that. What are you looking for in terms of Fed Chair Jay Powell and what he may say, not necessarily what he may not say?
I think a lot of people are looking for him to give some sort of indication that he is on board with the comments of these Fed bank presidents who think we should get started with tapering. Now, that doesn't mean tapering early, but that we should get started with it. And here's why. The last time the Fed tapered after the great financial crisis, it started raising rates before it started tapering. You can see the yellow line there is when they started raising rates, and you can see what happened to the 10-year yield. Yields went up. When they started tapering, yields were going down, but that was because we were headed into contractionary conditions. So at this point, the Fed would like to get started sooner so they can separate the idea of tapering and tightening. Now, what could derail that at Jackson Hole, or we're not going to be at Jackson Hole, for Jackson Hole? That could be COVID. Now, most of the Fed bank presidents say they want more time to see what happens with the data, but Esther George told me yesterday she's not particularly concerned.
All right, we will have to see what impact this flare-up in the virus might bring. So you could imagine that it might slow down some of the returns to the labor market, but I don't expect at this point that it will derail the economy as we saw last year when we first had to deal with the virus.
So to answer your initial question, Lisa, I think the Fed chairman is going to probably say we've made progress on the economy, but we're not quite there yet in terms of our mandates. You look at the mandates, and yes, you can see the white line there above the red, which is their target for inflation, but the blue line is unemployment, not quite down to where they think full employment should be. If we get another drop down a week from tomorrow, maybe the Fed is going to be ready at the September 22nd meeting.
Michael McKee, thank you so much. We'll be looking for that jobs report coming out next Friday. Meanwhile, former Fed Governor Randall Kroszner weighing in on the challenges facing the Fed in the face of rising prices. Here's what he had to say.
The question is what's going to happen going forward? Is this kind of a one-time adjustment that we made up for lost time, output, and demand, and so prices have moved to a new level? Will they just kind of stay along there, or are they going to continue to rise? That's the challenge that the Fed has, and that's all about managing the expectations of what's coming next.
Joining us now, David Leibovitz of JP Morgan Asset Management, Emily Rowland of John Hancock Investment Management, and Michael Schumacher of Wells Fargo Securities. A phenomenal panel. Thank you all so much for being with us. David, I want to start with you. And really, some of the push-pull here relies on what's the potential biggest policy error for the Fed, moving too quickly or moving too late? And right now, they have been saying it is too quickly. That is the biggest risk. Do you disagree as you look at the data?
I don't disagree. I think that, Mike made a very good point just now that there's a pretty significant difference between tapering and tightening. And so, what I think the concern, at least from where we sit, is the economic data has been coming in a little bit softer than expected. The inflation data may have peaked for the time being, but it's certainly been running a bit hotter than people think. I think that the market has this view that the Fed is more focused on inflation as opposed to the real growth story and the labor market story. But actually what the Fed has told us is that they're thinking about it in the complete opposite way. And so, with labor market improvement until this most recent month, a little bit slower than people were thinking. Obviously, the economic growth numbers not reflecting the big surge in activity that a lot of folks had penciled in for the back half of this year. I think that, the risk here is that the Fed moves too quickly. But one of the things that we learned from the Fed during the prior cycle, and I do think that this is going to repeat itself, is that they're gonna err on the side of caution. This is a Fed that's going to measure twice and cut once, and so again, the risk is that they move too soon. But we don't necessarily think that that's the way things are going to end up playing out.
Emily, how do supply chain disruptions fit into this, and how, given the fact that they are pressuring prices upward?
Yeah, this is an important consideration right now. And what we're seeing is that these supply chain constraints, and Lisa, you tweeted about this morning, are extending this challenge in terms of inflation being potentially a little bit more sticky than we imagined. So that certainly puts the Fed in a difficult position as they are seeing these inflationary pressures perhaps not being as transitory as expected. But at the same time, we're moving ever closer to their goals with the jobs market continuing to heal. And with that, again, that string of good data as it relates to jobs, as it relates to the rest of the economic picture here in the U.S. So certainly a challenge. We agree with David that we think that they'll be patient. The problem is that right now the Fed is in fifth gear. They're implementing warlike policy. Their balance sheets doubled since the pandemic, and you're not really supposed to stay in fifth gear for all that long. So we do see the Fed shifting down into fourth gear, announcing potentially tapering in September, starting that with the tapering of about 10 billion in purchases per month in 2022, and slowly shifting down as they get to more normalized levels in the next year.
Michael, here's what I'm struggling with. I'm looking at a market that people say reflects a very strong economy. They see this economy lasting longer because the Fed is not going to act too soon, and yet the yield curve just won't steepen. Why is that? Should the yield curve be a lot steeper right now where we are based on the Fed's lack of movement in the face of inflation?
Yeah, Lisa, it probably should be steeper. And we've made this case for a while, and it's been stubborn. I certainly agree with that point. The market's taking its cues from the Fed. That's pretty clear. The market's waiting for tapering. It's waiting for a hint. Is it going to get it from Jay Powell this week? We doubt it. But eventually, sooner or later, the Fed will get around to tapering. And at that point, we think yields back up fairly significantly. So yes, yields are awfully depressed, probably too much so, but market's really waiting on the Fed at this point.
And just quickly, Mike, to follow up, do you think that the Fed responds if there is a backup in rates?
Probably not in the near term. And I think the Fed's got a fair amount of latitude here. So consider the 10-year Treasury, 135 plus or minus. It was 175 back in March. The Fed didn't seem terribly spooked. In fact, Jay Powell referred to that as a vote of confidence in the U.S. economy's eventual recovery. So If the 10-year were to go to 160, 170, 180, would the Fed be terribly worried? I doubt it. If it went to 2+, frankly, I'd be shocked. But would the Fed respond then? Yes, probably so.
In the meantime, we're continuing to get data. Which data matters continues to be a question. U.S. GDP and personal consumption figures coming in just shy of estimates. For more, let's go to Bloomberg's Abigail Doolittle. Abigail.
Well, Lisa, certainly a lot of data this morning, a big data dump, in fact. However, to your point, what matters? In fact, markets not reacting all that much. Now, all of the data coming in this morning, just a little bit soft. Initial jobless claims a little bit higher than the estimate, a little bit higher than last week. The same deal with continuing claims, a little bit above the survey, a little bit higher than last week. As for 2Q GDP, it's amazing because up 6.6% on a historic basis. That is extraordinary. Slightly off the survey, though, better than the first quarter, though. And for personal consumption, a similar situation, up 11.9%, a little bit softer than the survey, but better than the first quarter. Overall, not a lot of reaction from markets, but where we are seeing a big reaction, not surprisingly, the 10-year yield backing up right now, up about 3 basis points. Not so much on the data, Lisa, but as you know, we do have this Fed talk out this morning between Esther George along with Bullard, both saying it's time to taper. So we see this backup in yields. That 10-year yield at 1.37%. As for the data and markets, the S&P 500, we have had record high after record high, this summer melt up, even as the surprise index for economic data continues to go down. In other words, Lisa, that negative correlation between stocks and the economic surprise. Bad news is good news, at least for stocks, Lisa.
Yeah, Abigail, thank you so much. And bad news is good news for stocks, especially because rates have remained so low. And I want Emily and David, I would love for your comments on what Michael was just talking about. This idea that the yield curve should be steeper in his mind, especially given some of the data coming out and the strength. I mean, Emily, do you agree? Is this something that really is that dissonance with the rest of the economy and something that will right itself in the near future?
Listen, the 10-year Treasury yield has basically been in a 40-year decline. And we see these sort of temporary backups reflected by things like better growth expectations. But there are some longer-term, really key elements here that we expect to reassert themselves as we get through this transitory inflationary period. Things like demographics, things like technology advancements are wildly disinflationary. So we actually see this downward trend in the 10-year Treasury continuing. That creates a problem, again, for the Fed. As the yield curve flattens, the Fed's going to have a really hard time raising rates and risking inverting the yield curve. So we actually think that we're going to be in a continued period of low rates, which has a lot of cross-asset implications that we can discuss.
David, what do you think about the assertion that Michael is making that basically when the Fed announces tapering, the long end will move higher? This has been a controversial point.
I would agree with what Michael was saying. And the other point I would make here is that I effectively take no signal from the level of rates at this point. I think when you have G4 central banks coordinated in their asset purchase programs, really difficult to explain or figure out what 1.36 on the 10-year actually means. And so I'm much more focused on the direction that rates are moving in. And I do think, given the state of the economy, given the outlook for corporate profits, that rates are generally sitting a bit too low. And so we very much expect steepening into the end of the year as well. And we think that will coincide with a revival in the more cyclical reflationary trade across the global equity market.
David, how much of a yield increase can stock markets tolerate?
So it's interesting. We've spent a lot of time on this issue, and historically, the magic number on the 10-year has been around 4.5%. So effectively, rates and equities could move higher together until the 10-year hit 4.5%. That relationship did break down after the financial crisis. We put the magic number somewhere closer to 3% in the current environment. And so, in a vacuum, rates can move higher before they cause indigestion in the equity market, but the speed with which they move is equally important. And part of what was so challenging at the beginning of the year, part of what caused so much volatility back in February and March, was that you were seeing these 2 standard deviation moves in the Treasury market over the course of a given week. Risk assets can't handle that, but risk assets can certainly handle rates that are higher than current levels.
All right, everyone's sticking with us. Right now, let's get a check on those stocks, in particular those moving ahead of the opening bell. Here is Katie Greifeld. Katie.
Hey, Lisa. Well, we are at the tail end of earnings season, and it's the retailers bring us home. Williams-Sonoma is your standout this morning, up almost 16% after beating estimates, though inventories could be worried down the line. Ulta Beauty, another beat and raise, that earned a price target upgrade from Cohen. And also in the beauty space, Coty climbing after beating on revenue, though its loss per share was a little bit greater than forecast. And finally, Dollar General, it actually beat on EPS, but its revenues were flat. That's weighing on shares before the bell. And let's check in on some energy names, since crude oil down by about 1%. That's its first fall this week, putting a little bit of pressure on names like Exxon and Occidental, with crude dipping back below $68 a barrel. And Lisa, I'll note that energy is your worst performing sector so far this quarter, so we'll see how the rest of the day goes.
All right, Katie, thank you so much. Coming up, the EU discussing whether to reimpose curbs on the U.S. Meanwhile, growing numbers of employers are starting to enforce vaccine mandates. That conversation coming up next. A bit of softness after the 51st record high of 2021 yesterday. Just a muted tone to markets as we head toward the opening bell. This is Bloomberg.
We talk about those NPLs. Will they stay high?
As all of you are very fully aware that the second COVID wave hit India hard and hit India suddenly. So obviously, I would say almost 50 days of the quarter were impacted in a very significant manner. And that has come through on the retail portfolio side. So while all the banks and financial institutions saw higher than expected retail slippages during the quarter, but we do believe it is transitory. We expect moderation in the second half of the year. We've already seen positive trends come through in the second half of June, and July has been much better than June, and I think the same trend has continued in August also. The demand resolution, which was 98%, is already reached 99.5%, or what I would say pre-COVID levels. There is a 26% year-on-year recovery, improvement in recovery.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
We will have to see what impact this flare-up in the virus might bring. So you could imagine that it might slow down some of the returns to the labor market, but I don't expect at this point that it will derail the economy as we saw last year when we first had to deal with the virus.
That was the Fed's Esther George speaking with Michael McKee of Bloomberg, expecting the economic recovery to persist despite renewed virus fears. This, as a recent spike in cases pushes the European Union to reconsider imposing U.S. travel curbs. For more, let's bring in Bloomberg's Kriti Gupta. Kriti.
Well, Lisa, I'm ready to plan that European vacation, but it looks like I have to wait. The EU really reconsidering some of their new travel guidelines, in particular, raising those COVID cases that they're allowing per 100,000 inhabitants from 25 to 75. That increase of 50. But for U.S. residents, that just might not be enough because we're at a rate of 507 new cases per 100,000 early August. So let's just take a look at what the COVID curve is doing, because it's not a pretty picture, especially if you're a foreign country looking in at what's going on with the U.S. You can really see that volatility, that increase in case count. It's getting even bigger and looks like it's going to continue to rise in September in particular. So what are Wall Street firms doing about it? Well, vaccine mandates, mask mandates, those are more in vogue. That visual you're seeing on your screen are all the companies that are starting to mandate employee vaccination in particular. Whether this helps or hinders the the labor market, that's really what the big question is, Lisa.
Thank you so much, Kriti Gupta. Right now, we still have with us, I am so pleased to say, Michael Schumacher of Wells Fargo, Emily Rowland of John Hancock, and David Leibovitz of JP Morgan Asset Management. And really the key question here is, how do we view the Delta virus? It does seem to be on the wane, but does continue to seem like it is crimping economic activity. Michael, what's your sense of how you read the COVID numbers at this point and how it factors into your market call?
Yeah, Lisa, they're a bit scary, no doubt about that. And I think there are a lot of cross currents out there when you consider the potential impact in the U.S. and Europe. But from a market standpoint, you've got to consider how will policymakers react to COVID? Are they going to be nearly as dramatic as last year or early this year? We think the answer is no. So unless Delta really takes off, and unless you see the number of people hospitalized go to some astronomical level, and in the U.S. case, state by state have a pretty intense lockdown, we think the economic and therefore market impact is fairly muted. So the personal toll is tough, the numbers are scary, but the economics aren't so bad at this point.
Emily, do you agree? I mean, at this point, is basically COVID over when it comes to the market?
I do, and I do want to touch on the personal impact, and my family's been impacted by it. It's very difficult. At this point, I think from a market perspective, we're learning to live with it. Companies are adjusting. Earnings estimates continue to move higher. I think it's going to become harder for companies to show leadership. And the ones that emerge are going to be the ones that have great balance sheets, the ability to maintain margins as margin pressure really becomes crimped as input costs go up, which we talked about earlier. So really focusing on the quality factor underneath the hood, again, looking for companies and sectors with great ROE, with the ability to grow organically as the economic backdrop here starts to slow and normalize is going to be critical. Just finding anywhere to take risk, which has been rewarded over the last 18 months, is going to be a lot more difficult as we head into the next 12 months or so.
Emily, what's the longer term consequence of all the debt that's been piled on to corporate balance sheets in addition to government balance sheets? The idea here that typically that slows growth. Is there a potential issue there down the line, or is it so far off it's not worth thinking about?
It's always a difficult question to put that into the right time frame. But right now, when we look at corporate balance sheets, they're actually quite healthy. And again, we're looking for those parts of the market that have the ability to show those great balance sheets and have the ability to look at those fundamental drivers as becoming more and more important. So certainly an issue that's consistently sort of kicked down the road, but again, looking very healthy from a fundamental standpoint today.
David, what's your sense here in terms of looking at the virus and how that factors into both policy and a market call? Are you still watching the numbers of hospitalizations and deaths, or is that basically rear view mirror?
So we're obviously still watching that data. I think it matters a lot more to the economy than it necessarily does to the market. I think, given what's going on with the virus today, the economy is running with a weight vest on. It's not going to move as quickly as perhaps it would have otherwise, but it's still able to move at a fairly decent clip. One of the really interesting data points we got this morning that we actually haven't touched on was the BEA's estimate of corporate profits for the second quarter. And what you saw was that the year-over-year change in corporate profits for the economy as a whole was far slower than what we saw for S&P 500 companies. And so clearly the kind of corporate America is a direct beneficiary to an extent of what's gone on with the pandemic. And we think that those very robust earnings can continue. And so when we think about that backdrop, along with what we were talking about earlier, where bad economic news has actually been good for the market, we remain fairly constructive on risk assets going forward. We think that the setup is good, the fundamentals are strong, and even if the economy takes a little bit longer to come back online, it's still moving in a very positive direction.
David, just to sort of put a bow on this, is this including cyclicals? Is this including the quote-unquote riskier aspects of equities, or is it just more broadly?
So I think you need to be more thoughtful about how you take risk at this point in the expansion. The small cap trade is one that feels a little bit less attractive from a risk reward perspective, but very comfortable taking risk through things like financials, industrials, international equities, it's about being thoughtful and choosing a little bit more carefully when it comes to putting risk into your portfolio rather than embracing a broad-based beta trade, which is very much what we saw last year.
All right, we'll pick up on that coming up. Everyone's sticking with us. Coming up, the morning calls and later the path to 5,000. Wall Street continuing to update forecasts amid the market's unprecedented rally. That conversation still ahead. This is Bloomberg.
Neptune was discovered, everyone wanted to do it because it was this clear demonstration that you can use math to discover objects.
Unfortunately, since then, no major planet in our solar system has been found. But thanks to modern telescopes, thousands of smaller objects have been discovered in the past few decades beyond Neptune, called trans-Neptunian objects, or TNOs. And planetary scientists at the California Institute of Technology have noticed some anomalies with these objects. Their hypothesis? A giant theoretical planet beyond Neptune, Planet 9. And thanks to a new telescope, equipped with the largest digital camera ever built, we may be one sky survey away from finally finding it.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
This is Countdown to the Open. I'm Lisa Abramowitz in for Jonathan Farrow. A quick look at the markets. We are seeing a bit of a softer tone today, although off just a touch after the 51st record high for 2021. I keep coming back to that, just the roll of bleeding upward as we head into the fall. Time now for our morning calls. A look at some of the analyst recommendations on Wall Street this morning. First up, Morgan Stanley downgrading Nordstrom to underweight with a $27 price target. The analyst citing limited demand for wear to work products as well as increasing cost inflation. Next up, Citigroup downgrading Phillips 66 to neutral with a $75 price target. The analyst seeing a slow recovery with persistent headwinds to profitability. And finally, Bank of America raising its eBay price target to $77 based on a new strategy from management. Coming up, the S&P more than doubling since the low at the onset of the pandemic. But there's little unity on Wall Street about what's next. This is Bloomberg.
lot's happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
I support the new framework.
We need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio. Global markets never sleep, so stay connected with Francine Lacqua in London, Matt Miller in Berlin, and Kaylee Lyons in New York. Perspective on the day ahead. Bloomberg Surveillance, early edition. Weekday mornings on Bloomberg Television.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
This is Countdown to the Open. I'm Lisa Abramowitz in for Jonathan Ferro, just moments away from the opening bell, and we could see a little bit of red on the screen, led by the NASDAQ, actually down 0.2% in tandem with the Russell 2000, as you do see those yields move higher. S&P down about 0.1%. If you take a look at those yields, the market move over the past few days has been notable. We've got 135 on the 10-year, which is substantially above the 120 we were at not so long ago. A bit of softness in crude, and interesting to see the dollar strength actually gaining steam, especially after comments from Jim Bullard and Esther George about potentially tapering sooner and not letting the Delta variant get in the way of that. Of course, this comes ahead of Jay Powell, Fed Chair's speech tomorrow at 10 a.m. Eastern. Let's head to the markets desk. Bloomberg's Abigail Doolittle joining us now. Abigail.
Lisa, let's start out with some earnings movers because we have two big gainers, winners, and then one laggard. Starting out with the shares of CRM or Salesforce.com. They are popping sharply higher, up 3.4%. The company put up a strong beat and raise quarter. Lots of price targets on the street raised, and a big difference from a couple of quarters ago when they pre-announced the downside and the stock tumbled, now well above those levels. Snowflake, the software company, also sharply higher, up 5.7%. They raised their full year sales forecast. Autodesk, not so much, down 7%. They missed earnings, shares being punished as a result. You're mentioning those yields continuing to back up, that 10-year yield, amazingly, at 1.37%. Lisa, that's helping out the big banks. The reflation trade back in order for sure. If yields keep rising, though, it'll be interesting to see whether or not it goes from reflation to inflation. Either way, though, it's likely to help out the banks and financials. Indeed, right now, the top sector, although only up 0.2%. Lisa.
Yeah, but up nonetheless when you see the NASDAQ underperforming on a day when yields and big tech seem to go in tandem. Abigail, thank you so much. More fuel for the equity bulls as another firm calls for strong returns next year. Strategist at UBS expecting the S&P 500 to reach 5,000 by the end of next year, writing, quote, this combination of solid growth and still supportive Fed is a favorable backdrop for stocks, even if the equity market has already produced eye-popping gains. For more, Bloomberg's Kriti Gupta. Kriti.
Well, Lisa, you said that 5,000 for UBS, yet the latest Wall Street firm to come out and say, well, stocks are going higher, 11% gains over the next 16 months. That's what they're predicting. Let's put that into some context, though, because year to date, you've seen the S&P 500 rally 19.7%, just shy of about 1/5 of their initial value. So one trader I spoke to, though, said, why even invest in a fund when you can just track the S&P 500? I mean, look at those gains on that screen. Even hedge fund picks haven't been able to keep up. Goldman Sachs pointing out that only 33% of hedge funds are beating benchmarks in the second half versus 57% in the first quarter of 2021. But Lisa, UBS seems to have the right idea, at least based on the latest AAII survey out today, where bulls jumped 6 percentage points and bears fell by a whopping just 2 percentage points. So you are seeing a little bit of bullish confidence here, bulls gaining a bit of confidence, I should say. But Lisa, you know better than I do, it could be anyone's game.
Yeah, thank you so much, Kriti Gupta. Back with us now, David Leibovitz, Emily Rowland, and Michael Schumacher. Emily, does it concern you that the bulls are getting more bulled up?
A little bit. You know, when we look at sentiment, we want to make sure it doesn't look too, overly optimistic. And we're actually not seeing that. If you look at the flow data, money is starting to re-engage in areas like money market funds. Investors continue to pile into high quality bonds. And we do think equities need to do a little bit more of the heavy lifting here. We are slightly overweight equities in a portfolio, but we want to be mindful of how we're taking risk. And David hit on this briefly before. As we enter this mid-cycle environment, it's no longer just about taking risk in every corner of the market. We want to fade that reflationary trade. We want to have offense in a portfolio, looking at areas like industrials, looking at areas like U.S. mid-cap equities that can benefit as this economic recovery continues. We want to be very thoughtful about, getting kind of away from that more cyclical trade, as the macro mosaic right now is painting a picture that peak economic growth is behind us. And I think we could probably all agree that it's unlikely that we're going to do another $5 trillion in fiscal stimulus and that the Fed's going to be doubling the size of their balance sheet again. So just being more thoughtful under the hood, I think, is the name of the game.
Mike, one of the backdrops of this whole scenario is rates that have been incredibly low. And there is this feeling they'll move higher. You were just talking about how they ought to be higher, and that yields should go that way later on in the year. However, it's unclear how much of a boon low rates have been to equity valuations. What's your sense of that in terms of the dollar figure, the valuations, the sense of how much returns could be sucked out of equities if the Fed starts to remove accommodation?
At least it's interesting. I'm talking to my equity colleagues at Wells Fargo. They always highlight the idea the low yields have been terrific for growth in particular. I agree with the idea that if you had just bought really any major fund or a series of stocks over the last 18 months, you would have done really well. That's fine. But going forward, it does seem to us and to our team at Wells that this notion of low yields have been super positive for growth continues. So if you extrapolate, you'd say, all right, well, if yields go up a bit as we anticipate, where is that tipping point? Probably a ways off, but maybe not more than 6 to 9 months. So this notion that equities can go up forever seems a bit stretched, but as long as the central banks cooperate and aren't too tight, it probably does help quite a bit.
Mike, what's the threshold of yields at which point they become a haven investment, right? I mean, the idea that at what point do they become so attractive to those overseas and to anyone, frankly, that sees a disruption, a hiccup in, for example, big tech, which seems to trade in tandem?
Yeah, that's really interesting, Lisa. And if you look at the data, for instance, for the last 10-year Treasury auction, which I'm sure every Bloomberg viewer has devoured like I have, you can see there's been a tremendous influx from overseas. You might not expect it because yields are low, and you could say, well, why would I buy a 10-year Treasury at 135 today or 120 something a little while ago? But in terms of adding some ballast to the portfolio, it's been pretty popular. And I guess the last point on that topic I'd make is that when you look at U.S. assets after adjusting for foreign exchange hedging costs, they look pretty good. So yields are low, but taking out the FX component, they don't look bad, in particular versus overseas investments.
Meanwhile, David, this idea of big tech trading in tandem with yields, do you think that that relationship, that correlation continues for the foreseeable future? Or do we start to see a divergence later this year?
I think that it'll continue for the foreseeable future. But, when we think about technology, we try to separate, and this to an extent aligns with what Emily was saying, but we try to separate between, the stocks that are really generating the majority of their returns based on valuation, and those stocks that actually have demonstrated an ability to grow earnings quite solidly over the course of the longer term. And so, the way that I think about it is the primary channel through which higher interest rates would pressure the equity market is vis-a-vis valuations, and that makes the earnings story all that much more important. And so whether it's looking within the growthier parts of the market and really, gravitating towards those big growers, those cash flow kings, or whether you look at relative valuation and say, the cyclical parts of the market continue to look cheap on a relative basis. Valuation dispersion within the S&P 500 is at its widest level since the tech bubble. Those types of names should continue to benefit from an economy that grows above trend. So again, I think that, we're all to an extent in agreement here where it still makes sense to take on risk in portfolios, but you need to be more thoughtful about how you're taking that risk on and what you're allocating to within the broad menu of global capital markets.
Sticking with big tech and other potential risks here, it's not just higher yields, it's also the potential for higher taxes. And we talked about the UBS call for 5,000 at the end of next year. That includes an expected 4 to 5% increase, or a 4 to 5% drag from the increase in corporate taxes. How do you account for the likelihood that taxes are going up?
So, one of the things that we've observed over time is that analysts don't tend to price in changes to earnings estimates until the ink is dry on any sort of adjustment to the tax code. And so, we've obviously modeled it out. We would be generally in agreement with what it sounds like the guys at UBS are thinking, which is, 4 to 5%, call that $9 or $10 a share out of 2022 earnings. But, in general, our work also suggests that when corporate taxes are increased, individual taxes are increased, as long as that occurs against the macroeconomic backdrop, which is relatively solid, markets and consumers have been able to take that in stride. And so, we're always big believers that as investors, we need to play the hand that's being dealt. The hand that we think is going to be dealt contains higher corporate and individual income taxes. And so, again, it's about being more selective and finding areas where that's going to pinch the least, rather than continuing to embrace broad-based market exposure.
All right, we'll elaborate on this conversation coming up. Everyone's sticking with us. Right now, let's get a view of what's going on in those markets in the first 10 minutes of trading. Abigail Doolittle has been tracking it all. Abigail.
Well, Lisa, not a lot right now, actually. We just have the S&P 500 shy of its all-time high. Lagging, though, the reopening trade, at least the natural resources part of it. Energy is the worst sector on the day, in line with the energy sector down. But the banks, on the other hand, because of yields continuing to back up, big gains. That is the top sector on the day, with JP Morgan, Bank of America, Morgan Stanley, and Goldman Sachs all sharply higher. As for the energy, there you see energy and Halliburton both down. Metals and miners lower as well. The Bloomberg Commodity Index off just a little bit. So it's interesting to see those mixed messages within the reflation trade. And then finally, Bitcoin back below, solidly back below $50,000 per Bitcoin. That is, in fact, weighing on the crypto space. Lots of red there. But overall, not a lot happening, at least on the surface level, Lisa.
Abigail, thank you so much. Coming up, the airlines bouncing back this week, shrugging off mounting concerns about the pandemic, threatening the U.S. travel recovery. That conversation coming up next on a day that feels like an August Thursday. This is Bloomberg.
Session started and wrap up the trading week.
News.
Who knew that one earnings story could take the entire market? There's upward pressure on wages.
Analysis.
This is really a slow, ongoing implosion.
Context.
Is there veracity to this granular data of ADP?
It's an ugly report.
The power of the Bloomberg terminal. The power of Bloomberg television and radio.
Tesla's the one that we got our eyes on.
Bloomberg has it covered.
A lot of modern cyber attacks are a chain of 2, 3, or even more vulnerabilities in a row that have to be successfully exploited. And if you can reset the adversary back to the beginning of that chain and force them to go through the whole thing again, that's also an aspect of incurring a cost on them. The reboot, for example, there's no burden to it. All modern phones have a way to do that in an automated fashion. You set it once. Mine reboots at 3 in the morning. I'm not using it then. It's sitting in the charger. And then it reboots and I get that benefit.
Like so many of the passenger airlines, our ridership contracted significantly back in March and April of 2020. Now we're at about 65 to 70% of ridership recovery, with stronger bookings into the fall season and beyond. So good ridership recovery, which I think underscores the essential nature of the services that we provide.
Renewed virus fears weighing on the travel recovery, with the team at BMO seeing a slowdown in momentum, writing, quote, "While the evidence is largely anecdotal at this time, passengers' willingness to travel appears to be waning in August following the strong trend in bookings seen in June and July." Let's get some more, let's get to Bloomberg's Katie Greifeld. Katie.
Well, Lisa, it's interesting because we really haven't seen those worries come to the surface in a big way in the stock market. Really, if you look over the past week, it's airlines and hotels that are outperforming, both climbing over 7% over the past few days. Ports also higher by about 2%. And crude oil, even with today's drop, it's gained about 6% this week, Lisa. And on the other side of the trade, the stay-at-home stocks, they've been holding their own, but really they're trading sideways at best. We're looking at the Seoul Active Stay-at-Home Index here, and even though it's almost 80% higher since the start of 2020, it hasn't been able to break above that February peak, just treading water for the past few months. But Lisa, whether this is the start of the next wave of the reopening trade or just a false dawn, it remains to be seen, because we do have those worries building. And if we look at the alternative data, things like open table bookings, TSA numbers, they're all starting to roll over. And given that mobility data has really been the bull case for months for those reopening names, we'll see how long that outperformance can last, Lisa.
Katie Greifeld, thank you so much. And really, this comes on the heels of what should have been the Jackson Hole confab. This was the time when people would be gathering and Fed officials and academics would be discussing things. They are not. It was canceled at the last moment. Joining us now, JP Morgan's David Leibovitz, John Hancock's Emily Rowland, and Mike Schumacher of Wells Fargo, gracing us with their presence. Thank you again for being here. Emily, let's start with you. I honestly have been watching cancellation after cancellation, not only of events, but also hearing about people canceling their vacations. How much do you look at this and actually start to trade on it, and how much do you look past it?
You know, of course, we look at it over the short term. It's got a huge impact to the economy. And we look at some of that same high frequency data that was just cited, and we're starting to see it pause, but not roll over. So I think we're all sort of taking a breath here. I know for me, I was about to get on an airplane for the first time for work next week. I've been on one a few times personally, and that meeting was canceled. I've got another engagement in October, which I'm not sure if that's going to happen. So I think that's going to put pressure on areas like airlines and hotels, where there's maybe a little bit less price sensitivity, sorry, John Hancock, than there might be personally. So I think, you know, you could see that put pressure in the short term, but we do expect to reemerge from this. And as I mentioned earlier, I think we've learned to sort of cope with and live with COVID in certain ways that we'll be able to continue to see this reopening play out.
Mike, what about you? I mean, in terms of the travel, have you been canceling travel? Have you had work travel canceled? Do you expect to ever be in a situation where we end up traveling the way that we used to?
It's been pretty spotty, Lisa. So I, too, have not been on a plane yet for work. I think I might do that fairly soon, but not quite yet. And I think that when you consider the response from organization after organization in terms of postponing return to office by a month, 2 months, 3 months, you probably need a switch in that to really dictate travel plans, perhaps more vaccine mandates, something like that. But we're not there yet. So does it get back to full speed travel? Not this year, probably not next year. After that, who knows? Open question. But I do think it'll ramp up a fair bit over the next 6 months, Lisa.
But this really reflects a large sea change, frankly, in the economy, from a work from the office view to a work from we don't really know where. Perhaps there'll be some more flexibility. David, how do you play that trend as we start to see some of the Wall Street firms delay back to work plans? The idea that perhaps you get the likes of Ford trying to compete with big tech by offering more flexibility to workers. I mean, how is this baked into markets, and how is it not yet fully priced that we're in a changing world?
So I think the most significant thing for investors to recognize in the current environment, and particularly as it relates to return to office, is that, you know, we live in a services-based economy, and in a services-based economy, arguably the most valuable capital that you have is human capital. And the best way to develop human capital is vis-a-vis in-person interaction. And so, to me, the way that I think about it is the role of the office is changing. It's going from a place that we used to go and spend, 60, 70 hours a week doing individual work, tapping away at a spreadsheet, to a place of collaboration. And so the real opportunity exists in figuring out what those collaborative environments are going to look like, figuring out what resources people will need to effectively meet and share ideas when they are together in person. That's really going to be the key to success when it comes to figuring out the office story going forward. I saw a headline the other day that suggested office was the new retail. And while I'm somewhat sympathetic to that, I do think it's different, because at the end of the day, you don't build an office for a Friday in August. You build an office for a Wednesday in February. And so we need to think about the peak load factor, and that's going to require companies to continue to have significant space so their employees can get together, collaborate, share ideas, and grow earnings over the longer term.
Well, I want to thank you all, David Leibovitz, Emily Rowland, and Mike Schumacher. I do also want to just bring you some breaking news. The Pentagon is saying that an explosion at Kabul airport it has occurred, and that there are unclear casualties. However, this is something that is ongoing. The explosion is reportedly large. There has been a lot of volatility there. Of course, as the tragic situation has unfolded, the U.S. has been withdrawing troops as planned, getting all of them out by August 31st. There has been a real ramp up of trying to get people out, but then we have heard about the Taliban circling the airport, which had been a focus for the U.S. Army. This has been an ongoing issue. We will bring you the latest. In the meantime, let's get some sector price action this morning. Let's get to Bloomberg's Dave Wilson. Dave.
Thanks, Lisa. I mean, you've got 8 of the 11 main industry groups in the S&P 500 lower. Utilities are the biggest declines. Also, the consumer discretionary category, where you find retailers, not so well received reports out of the 2 biggest dollar store owners, Dollar General and Dollar Tree, kind of weighing on that group. Financial stocks are one standout in terms of what's higher in the S&P 500. I want to focus in a little more on software, though, because we had sort of a back and forth late yesterday. Salesforce.com's quarterly numbers well received. Autodesk, not so much. And when you put that all together, I mean, it raises the question of whether this group, which has really been on a tear for some time now, set a record on Monday. If you're looking at the S&P 500 software index, whether it can do the same today, it's very much an open question. You have roughly half the stocks up and half down at the moment.
Dave, thank you so much. Just want to reiterate some breaking news from Kabul, that there has been a large explosion that is being reported by the Pentagon in the Kabul airport. For more, let's bring in Bloomberg's Anne-Marie Hordern from Washington. Anne-Marie, what do we know?
Well, Lisa, all we know right now is what we heard from the Pentagon spokesman, Mr. Kirby, saying that there was an explosion at the Kabul airport. Now, this comes on the heels of a very prudent message, it seems like, in the middle of the night last night, Kabul time, around 3:40 a.m. Kabul time. The U.S. Embassy there did put out an alert. It's for Americans to avoid the airport and at all costs, please leave these gates. There's about 3 gates that we're focusing on: Abbey Gate, East Gate, and North Gate. And that was the alert from the U.S. yesterday, as well as some of the allies as well, like the United Kingdom. We already see some other countries starting to stop the evacuations of civilians because of the worry of a terror attack. And then we have today the news from the Pentagon officially saying that there was this explosion at the Kabul airport. But Lisa, it's a very fluid situation. We're still waiting for more details.
All right, and just can you give us a sense of the lead up to this in terms of the Taliban surrounding the airport and what their progress has been in terms of gaining ground there?
Well, it's a very scary situation given the fact that the Taliban has control around the airport. Basically, a lot of security and checkpoints. But the other thing, and this is what the administration has been talking about in the last few days, and the reason why they did not want to extend that August 31st deadline is because they were worried of a terror attack from the likes of ISIS-K. Now, this is the ISIS's affiliate group in Afghanistan. They started there in around 2015, but they are a sworn enemy of the Taliban because they have different views on Islam and a number of other issues. You could see how this is a very scary and precarious situation, given the fact that you potentially have a resurgence of ISIS-K because of the U.S. military there, as well as the Taliban surrounding the airport. But again, we don't know who is responsible for this explosion, but we do know that there was this happening at the Kabul airport, and we're waiting details more from the administration as well as from the Department of Defense.
And Anne-Marie, this comes at a time when there are reports that there are about 1,500 American residents, not to mention all of the potential cooperators with ally soldiers that still remain in Afghanistan. In other words, there still are people who may want to be leaving. What do we know about how far the evacuation strategy has gone and what it could be remaining if there is this disruption at the Kabul airport?
Well, we're still waiting for more information, but just about an hour or so ago, the Pentagon spokesperson, Mr. Kirby, actually said that there are reports that we are winding down that civilian withdrawal, and he's for the next 36 hours, and he said that is not true. So potentially we thought that we would see maybe more civilian evacuations over the coming days. This bomb that has gone off in the airport has certainly probably shaken a lot of this timeline. Another thing to consider as well, Lisa, is that there have been talks, and President Erdogan of Turkey has signaled that they would want to stay, cooperate with the Taliban, and maintain security of that airport. They were doing this for years as well before to make sure that civilian flights can continue after the withdrawal of the United States. Potentially, given what we're seeing right now at the airport, a lot of things can change.
Meanwhile, we also are getting reports that Russia actually is withdrawing individuals as well. So this is one country that was actually supposed to be maintaining a presence, but they are evacuating because of this situation. Can you give us a sense of what this means in terms of that geopolitical potential alliance?
Well, Russia was potentially going to want to work with the Taliban, as was Xi Jinping of China. We know that actually Xi Jinping and President Putin over the course of the 24 hours had a phone conversation where they discussed this, but they also wanted to make sure that there wasn't a resurgence of militant groups coming into from Afghanistan, either former Soviet states or that 48-mile border between China and Afghanistan. Yeah. If Russia is now starting to unwind, they said that they would keep their embassy there. So I imagine this has completely spooked them, and they just want to make sure that their people are secure.
Anne-Marie Herdern, thank you so much for being with us. Right now, let's get you caught up on what you need to be watching this week with our trading diary. President Biden meeting with Israeli Prime Minister at 11:30 Eastern. Then the U.S. Treasury auctioning off $62 billion in 7-year paper at 1 p.m. Always a volatile one for some reason. A busy Friday with personal income and spending numbers. Plus, we'll get PCE inflation data, the key figure that the Fed looks at. And finally, it's the main event, the Fed kicking off its virtual Jackson Hole Symposium. Chair Powell taking center stage. Today, we are seeing a softer tone to markets after 51 record highs in the year of 2021, although we are getting positive on the NASDAQ now, and we are seeing yields kind of fluctuate a little bit more. This was Countdown to the Open. This is Bloomberg.
You can now fly into the UK from the United States. What about some reciprocity?
No, so the opening up by the UK government was terrific. We saw, in fact, the day that was announced, we saw our daily new bookings triple between JFK and Heathrow. So that was great. And as a US-based carrier, honestly, most of what we're going to sell is going to be in the US. So that was great for JetBlue. The US government should open up. There is no reason not to. You know, you can fly from countries that have much higher COVID infection rates, but you can't come from countries in Europe where infection rates are much lower. That is not a risk risk-based approach. When it's going to open up, I couldn't tell you. It's something that we and the other airlines in the US continue a dialogue on with the administration.
By Christmas?
I mean, hopefully even sooner than that. But of course, I don't really know. It's really hard to predict how they're thinking about it.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Jackson Hole Economic Symposium is going virtual. Bloomberg will bring you the latest with key discussions between central bankers and financial leaders, plus an extended edition of Bloomberg Surveillance Friday from 6 to 10. Coverage begins Thursday on Bloomberg Television and Radio.
Months after Hurricane Maria, Puerto Rico is still in peril. Huge swaths of the island are still without power, running water, or access to medical care. Experts estimate that it will take years before these services are restored island-wide. Much of the blame has been placed on FEMA for a slow response in comparison to recent disasters on the mainland. But recovery from a disaster of this complexity and scale has proven more challenging than anyone anticipated. And filling the gaps between an overextended public sector and a suffering populace falls on the private citizens. Robert Anderson is a Puerto Rico resident of 4 years.
The eye of the storm came in south of El Yunque, swept up towards San Juan, and out to Arecibo. Everything on the right-hand side is what we call the dirty side of the storm.
This isn't his first time in a disaster zone. With a military and telecom background, Anderson worked on repairing damaged cell phone towers in New Orleans after Hurricane Katrina. Some might be tempted to label him a disaster capitalist, seeking lucrative government contracts for his expertise. But as Anderson finds himself in the middle of a humanitarian crisis, he and his associates are developing a variety of pro bono recovery projects that target the island's hardest hit areas.
I see two Puerto Ricos. We're here in San Juan. They have telecommunications restored. They may or may not have power, but basic services are in place. They're able to get food. They're able to buy things. They're surviving. And when you look outside of the San Juan area, you can go 15 minutes from here and find areas that are devastated. I'm working on the devastated side.
Today, he's put together a boots-on-the-ground mission to provide medical care to some of the island's most isolated and vulnerable residents. Steve Berenbaum is one of Anderson's business associates. He offered an extra car and a set of hands.
So we received an initial report from a nurse that was out in the area. We're headed to the northeast region of Utuado for some people that are in need of urgent medical assistance.
Dr. Sally Priester is a physician from San Juan. She filled a van with medical supplies at her own expense and brought along a team of nurses. Google Maps estimated our first destination to be a 90-minute drive. But it didn't account for obstacles like this. Our first stop was the home of an 82-year-old blind Vietnam veteran. His roof was blown off by the storm, and he's been living alone in a back shed for nearly 2 months.
His cane actually got broken in the storm, so he's limited mobility. He has a number of medical ailments. Dr. Priester's having a look at him. We called the VA. They're going to get him set up with what he needs, get him stabilized so he can then be transported either to an evacuation center or off the island. It's when the chain gets broken, when those families that are connected to them leave the island or take off, these guys get left at the end of the road, and it's tough.
FEMA was not officially part of Robert's team, and their arrival caught everyone by surprise. Their job here was to survey and report back to their superiors, and did not come with medical aid of any kind.
People think that FEMA is there to hand out bottles of water. It's not what they do. FEMA has a role to play. They have a very specific role. They bring in ships, they bring in airplanes, they bring in tractor trailers with pallets of things. But they're a big machine, and there's gaps in that thing. And you're seeing one of the gaps here, and we help fill that role. These guys are in a bad situation before, and now they're struggling for real basic things. One of the risks that you run is people going from fear to hopelessness. Those are the folks that we're trying to reach.
And how are they reached? How are they even found?
Word of mouth, mostly.
And what's your role in all this?
Ghost in the machine. I'm lucky enough to be able to communicate with folks in FEMA, the state of Puerto Rico.
For a ghost, Robert makes his presence well known. Not only was he the de facto leader of the mission, now with FEMA in tow, he created his own maps to survey storm damage.
So we're right here.
And delivered them to FEMA HQ free of charge.
I have pretty good reach.
Perhaps that's how he managed to earn himself a coveted FEMA badge without actually working for them. And it's these relationships that allow him to operate more efficiently than an NGO or a government agency.
We're able to resolve problems at a different level.
Our next stop was on a mountaintop, a family of 11 struggling to care for their special needs brother in what was left of their house.
Probably we are the first health team to come and visit this family.
Muy bien, todo muy bien.
The patient has Down syndrome. He's all day in bed. The difficulty with this is the patient cannot be alone. The most important thing is that you need to take care of the chronic disease besides disability, because they have been not going to a doctor, and no doctor has come in here yet.
So we need a refill of this medication.
After maybe 54 days, it's not getting better. And the only way that you can be able to see that is coming to the ground, drive, and see the people and talk to the people.
You can see San Juan from here, but you can't get there. It's like the Emerald City.
On this stop, we caught word that a man living alone at the edge of the jungle was in need of care.
So we decided to take a little detour, come up here and check out and see what's going on. One of the challenges is to find those people that are at the end of these roads that need help.
¿Pero por qué estás solo? ¿Por qué estás por acá tan solo? I'm asking about why he's alone right here. He said things of life happens. Yeah, I'm here by myself. So ¿dónde vive acá? En la parte de... This is not a job. To do this, you need to have passion for what you can do. You're not going to get paid.
It's said in disaster response and emergency response that the real first responders are your neighbors. You don't need to wait for a lucrative FEMA contract to go out and do good and to help the community.
In the end, do you feel like you're making a difference?
Lives you touch and people that you can affect. I don't really think about it in those terms.
But why do you do it?
It helps me sleep at night. I think it's as much for the people that are going out to help and do things as it is for the people that you affect.
Whether out of altruism, or the lure of a paid gig, or some mixture of the two, Anderson hopes to stay here to help shape Puerto Rico's future.
Puerto Rico's essentially been a colony for 400 years. It was treated poorly by the Spanish. It was not treated well by the United States when they first got here. Puerto Rico can continue in the way that it's always been, or Puerto Rico can rebuild itself like nothing that's ever been. And we have to do everything we can to make that real. That's the bottom line.
When I met him first online, I found him to be really sweet. I think I was the one who was talking for an hour. He was just listening.
When we met, I saw her. She was beautiful, intelligent, and kind, which was, something that I was looking for.
Anshu and Sumit are one of about 12 million couples that get married in India every year. Unlike their parents' generation, they're not from two close villages, but from two cities on opposite sides of the country. And their love didn't start through community matchmaking, marriage brokers, or classified ads in newspapers, but began online.
So we met through jeevansati.com. So it's basically an online portal where we have detailed profile of different grooms and brides.
It makes a lot of remote profiles who are located in distant areas more accessible.
Thanks to growing internet and smartphone usage, matrimony websites and apps in India are starting to disrupt the matchmaking industry. More and more people are finding their partners at the click of a mouse. jeevansati.com, where Anshu and Sumit met, is one of the biggest players. Young Indians looking for love set up profiles including their caste and horoscope, but their criteria for choosing spouses appears to be changing.
We have seen the shift from, traditional caste community conservative parameters to something like which is more focused on education, employment.
Anshu and Sumit's marriage was initiated by their parents, but modern Indian couples like them have more input than previous generations.
We looked up to them to agree for the proposal, but it was primarily our decision that we wanted to be with each other.
So what's the emoji like you'll use the most to send to each other?
There's a bear, which basically we use for indicating a hug.
Yeah, that's our language basically. Bear icon for a hug.
Time flies when you're in love, and just 1.5 months after they first met online, the couple got engaged. They decided to hold their wedding less than 3 months later. But planning a traditional Hindu wedding on such short notice is no easy task. The massive event usually lasts 3 days, has various ceremonies and celebrations, and involves the entire two families and hundreds of guests. Luckily, there are websites and apps for that.
We searched online, we got in touch with Wedding Brigade, and they helped us finalize the venue. And it makes the search faster and efficient.
Startups like the Wedding Brigade are challenging traditional wedding planners in this $50 billion industry. It provides various services from booking banquet venues to buying wedding gowns. The website makes money by charging commission from vendors.
People don't want to be limited to what is available around them. They want to know the entire range of options available before making a decision. And now it's easy to find almost everything on one portal.
Anshu and Sumit are officially married in a ritual that has gone on for thousands of years, but their love started in a very new way. Technologies might be changing the way couples meet, date, and get married in India, but they're definitely not changing everything.
The technology was only the first level help that we could get to find each other. Everything else was like very humanly and emotions and feelings there.
Massachusetts Senator Elizabeth Warren has become a symbol of everything the Republican Party stands against.
Everyone gets a right to basic health care. We need strong oversight of these banks.
A legal scholar and a consumer advocate turned politician, Warren has branded herself as a champion of the working class and made a career out of standing up to big business. While rumors of a 2020 presidency bid remain just that,
I'm not running for president.
her Senate seat is up for re-election in 2018, and Republicans are already pumping millions into super PACs to defeat her. This is the story of how a law professor and politician came to be seen as the biggest threat to Republican values and the greatest hope for progressive America. Elizabeth Warren was born Elizabeth Ann Herron, the youngest of 3 siblings, on June 22, 1949 in Oklahoma City to middle-class parents. After waiting tables to help her family pay the bills, Warren became a star on the high school debate team. She landed a scholarship to George Washington University at the age of 16, but 2 years later dropped out to marry her high school sweetheart, Jim Warren. By 1980, Warren was a mother of 2, divorced and remarried, had earned a bachelor's degree from the University of Houston, a juris degree from Rutgers, and practicing law in New Jersey. Warren then went on to become an influential law professor, teaching, lecturing, and publishing highly cited work on bankruptcy and commercial law at 7 universities around the country, eventually settling at Harvard Law School. But Warren wasn't always a liberal lion.
Elizabeth Warren used to be a Republican, actually.
That's Stephen Dennis.
I'm a Senate reporter for Bloomberg. Around the time that Elizabeth Warren switched parties, she became a fierce opponent of a Republican drive to make it much harder to file for bankruptcy. She fought that for a decade. It ended up passing anyways.
While her efforts ultimately failed, her warning calls were heard in 2008.
We're in the midst of a serious financial crisis. Our entire economy is in danger, and without immediate action by Congress, America could slip into a financial panic, and a distressing scenario would unfold.
Professor Warren was tapped to help with oversight in the government bailout.
She would excoriate bankers and their bonuses and their practices.
Why should the U.S. taxpayer alone carry city?
She proposed a series of tough regulations, which became the basis for much of the Dodd-Frank financial law that we have today. That sort of catapulted her to national stardom, particularly among the progressive left.
Encouraged by her newfound notoriety, Warren declared her bid for the U.S. Senate on September 14, 2011. During the race, her opponent Scott Brown tried to derail Warren by accusing her of falsely claiming Native American heritage, a controversy that earned her the nickname Pocahontas. Nevertheless, she was victorious and won the Senate seat by a comfortable margin. She used her new tenure to challenge everyone, from banking regulators and Treasury officials to members of Wall Street and Congress.
I'm really concerned that too big to fail has become too big for trial. We need tough new laws to hold corporate executives personally accountable. No one should be above the law.
She called for Wells Fargo CEO John Stump to resign for fraud, introduced the Bank on Student Loans Fairness Act, and reintroduced the 21st Century Glass-Steagall Act. In 2016, after staying silent during the Democratic primary battle, Warren finally endorsed Hillary Clinton and had some harsh words for candidate Trump.
Donald Trump is a loud, nasty, thin-skinned fraud who has never risked anything for anyone, and that is just one of the many reasons he will never be president of the United States.
But she was wrong.
The forgotten men and women of our country will be forgotten no longer.
Warren wasted no time resisting Trump's agenda.
Have you ever managed or overseen a $1 trillion loan program?
I have not.
How about a $1 billion loan program?
I have not.
Okay.
In the Donald Trump era, Elizabeth Warren has been playing defense and trying to prevent Donald Trump and his cabinet appointees from rolling back protections that she helped enact.
Warren actually found herself rebuked by Mitch McConnell for reading a letter by Coretta Scott King about Jeff Sessions' record on racism during his confirmation.
She was warned. She was given an explanation. Nevertheless, she persisted.
That moment became something that's on T-shirts, bumper stickers, slogans, and that really galvanized a lot of support for her. It's been very hard for Republicans to get much of anything done this year, and that's at least in part to this resistance movement that Elizabeth Warren has helped champion.
We are here to fight back.
Enough of Elizabeth Warren. Like you,
millions of dollars are being funneled to defeat Warren in the midterm elections in 2018. But it's the rumors of a 2020 presidential bid that has further prompted powerful donors to fund her opposition, often using the same playbook of constant and ruthless ad campaigns that many believe helped Trump win in 2016. It's anyone's guess if she will endure what Hillary could not.
You know, the question for Elizabeth Warren is whether she can go from being a liberal firebrand to somebody who can regularly get 60 votes for initiatives in the Senate and 218 in the House and drive an agenda, and whether she can bring together coalitions for political victories. That's the challenge, and we'll see what happens.
Sadiq Khan, the mayor of London, has made some powerful opponents.
He doesn't know me, never met me, doesn't know what I'm all about. I think they're very rude statements, and frankly, tell him I will remember those statements.
My message to Donald Trump and his team is that, your views of Islam are ignorant.
He's the first Muslim mayor of a major Western capital and proud of it. This is how Sadiq Khan went from the son of Pakistani immigrants to a lawyer, lawmaker, and now the mayor of London. Khan's parents emigrated from Pakistan. His father was a bus driver, his mother a stay-at-home seamstress. The 10-strong Khan family squeezed into a 3-bedroom flat in South London. He wanted to be a dentist, but TV in the 1980s convinced him otherwise.
Objection!
LA law, with its swagger and ill-fitting suits, caught Khan's eye. He graduated in 1991 with a degree in law from North London University and joined a human rights firm. Khan worked a number of high-profile cases, often clashing with London's Metropolitan Police Force. But he had bigger political ambitions.
This is what being a new MP is like, squatting on a bench in the absence of an office, dealing with letters from constituents.
Reports are just coming in of an explosion here in London.
And there's just explosions, and then it was just smoke everywhere.
Everyone's just asking what's happened.
Only 2 months after Khan entered the Commons as a Member of Parliament, London was attacked by Islamist extremists.
That day will stay with me for the rest of my life.
He spoke out against the attacks both as a London MP and as a Muslim.
He has been very clear about his opposition to violence, opposition to terrorism, and has set out to make the case for a more open and peaceful Islam.
That's Thomas Penny, one of Bloomberg's Westminster correspondents.
Here is a man who is a Muslim, and he is standing up and being open and straightforward and being clear that the problem here is not Islam, but it's Islamic extremism.
In 2015, a decade after the attacks, Khan ran for mayor of London, and his faith was back in the headlines. His opponent, Zach Goldsmith, trying to link Khan to radical Islam.
The debate got again personal and nasty. The Goldsmith camp has called Khan extreme and accused him of associating with, quote, those who seek to do our police and capital harm.
It's a pattern of behaviour.
Even the former Prime Minister David Cameron repeated the allegations.
He shared a platform with Sajil Shahid, the man who trained the ringleader of the 7/7 attacks and accused the United States of bringing 9/11 on themselves.
But the smears didn't stick.
Zach Goldsmith ran a very negative campaign that was based on what people knew was a lie.
This election was not without controversy. And I'm so proud that London has today chosen hope over fear and unity over division.
After taking the mayor's office with a comfortable majority, Khan has brought a business-like efficiency to the role, scrapping expensive vanity projects like the Garden Bridge and the new Routemaster buses, which cost £350,000 each. The former lawyer who used to fight the police in court is now praised for his close relationship with them.
I was talking to a very senior police officer in the Metropolitan Police who said there was a sea change when he went into City Hall, and the police were saying how much they welcomed this because they knew where they stood and it was more straightforward to work with. So he works like a lawyer, he works like a government minister.
Khan's kept his faith at the fore. He's an outspoken voice for moderate Muslims across the world.
Donald J. Trump is calling for a total and complete shutdown of Muslims entering the United States.
Now, by giving the impression that Islam and the West are incompatible, you're playing into the hands of the extremists.
The ongoing spat between Khan and US President Donald Trump escalated when Trump went after Khan, misquoting him on Twitter just hours after the terrorist attacks of June 3rd, 2017. Khan's now one of the most prominent Labour politicians in the UK. In fact, a recent poll of Londoners found Khan was more trusted to keep the country safe from terrorism than the Prime Minister or the Labour leader. His story of going from the son of an immigrant bus driver to the mayor of one of the greatest cities in the world plays well with Londoners. But can he appeal to the rest of the nation? Has Khan got his eye on the top job? And is the UK ready for a Muslim Prime Minister?
What does it take to change the world? A big army? A cure to a pandemic? A revolution? All of these take either a lot of people, thousands of hours, or massive amounts of space. But for Julian Assange, all he needs is one room, an internet connection, and the world will listen. Assange is located here, and more specifically, right here. And from that location,